And my next guest actually puts money in my jeans, and he helps hundreds upon hundreds of investors every single year with helping them put money in their jeans. It's obviously, I'm speaking about a very, very close friend of REC Canada. We nickname him the Money Man, Mr. Christopher Desouza. I had to bring two Chris's on. And Chris, how you doing today, brother? Thank you for joining. I know you've been kind of backstage, and how's everything looking? Because I don't know really what's happening. I'm speaking to a lens right now, and so how's everything looking out there?
Doing well.
Good. Yeah, people chatting about and stuff like that in there. That's
the
good.
Team behind the scenes working hard for you.
Awesome. And so, Chris, what I wanted to speak to you about today is a couple of things, because so far, Chris Slightum and Patrick Francie have spoken about the fact that, look, if you invest into real estate for the long term, you will win. It's a matter of you taking the action step. And other than inspiring people to do that today, I mean, I'm not going to be able to go through this lens and actually make someone do it. But one of the biggest obstacles for my clients at times and investors at large is not necessarily going from getting their first property, but it's like, how do I get my 8th and my 10th property, right? Mm-hmm. And so I want to touch on that. I also want to touch on the fact that during the last 3 years, we've seen a big shift in what's happening with jobs. A lot of people have, to help their income, they've taken on other side hustles like the world of entrepreneurship and business. And so some of these people, though, have not only taken the leap, they've actually made it their full-time gig. And so in the world of financing, they're considered self-employed. Yep. And so I want to speak about helping some of our friends from a self-employed perspective. But before we get into that, I actually want to sit down with you now and talk about what are some ways and what do you do in particular with not only our clients, but investors at large. What do you do with them in terms of helping them scale out a property and not only get, like, say, for example, an income property, but maybe do two at the same time? Like, kind of let's educate our people from a 201 perspective of financing, not a 101, 101, because they've gotten that before.
Yeah, sure. So everyone's looking to grow their portfolios. The one thing that we notice a lot of the times is that everyone that comes, they're more interested in the cash flow. Okay, and cash flow plays a big role in our income and expenses when we do the rental offsets in purchasing multiple properties. But the one thing that we always educate, and we've been doing it for so long, Jazz. I mean, in 2005, when we first started, our whole thing was, let's educate. And you were the one that said to me, give away all the information for free.
For sure.
And
well, that's what we're doing today at the marathon. From what I know, nobody got charged to come onto this marathon, right? And so the thesis at REC Canada has always been lead with education, right? And Absolutely. Then at least people can make a quality informed decision themselves, but let's give the information up front so people can make that quality informed decision.
And you know what? Those decisions, that makes our job so much better, so much easier. It creates less stress and tension for the buyers that are getting into the market because they know exactly what they're doing from start to end. So what we do, and collectively amongst all of the real estate agents that we partner with, is we guide their clients through a process that lets them know where they are today, where they'll be in the next 3 years, where they'll be in the next 5, and where they'll be in the next 7.
Okay, so someone comes to you right now in today's environment, okay, and says to you, I own a property, and I'm looking into wanting to get a second income property. I have a principal residence. I want to get, you know what? Let's take a step back. I own my principal residence. I own 2 income properties, and I want to get a 3rd property now. How do you help them?
Great question. So a lot of times people will run into that wall. Okay, there's a point in time where you're not going to be able to get the financing. But why we do that ahead of time is so they know what they're doing when their mortgage comes up for renewal. Is it a 3-year term we put them on? Is it a 5-year term that we put them on? Are they cash flowing with the higher interest rates in today's environment? Are they negatively cash flowing? And what happens in that 3 years when that mortgage is up for renewal? So on the second property, we always want to be able to, the principal residence is what most people will use as what I call their piggy bank.
Okay.
That's what helps them get started in the investment world. Okay, so we're always leveraging the principal residence to go purchase the second and the third investment properties.
And are you doing that through like a refinance or a home equity line of credit?
So that's where the strategy comes in.
Okay.
Right? So we build out the strategies to say, based on the city that you're buying in, what's the appreciation in that city? Okay, most of the times, if it's in Toronto, if it's in the regular GTA, sometimes you say GTHA, which is in the Hamilton area.
Yep.
It's growing. All these markets are growing. So what we do is we take the appreciation rate in that city and we say over the next 3 years, approximately how much is your property going to appreciate in value and what's your principal pay down going to be at that time? So then we have a general idea 3 years prior to, if it's a 3-year term, how much equity we have access to at that time. Based on the amount of equity that we have, we prepare them in advance to say, here's what you can do now with this equity. Here's the type of property that you can buy. A lot of times what people will do in that space is they'll buy a pre-construction property temporarily in the interim.
Okay.
And as that property that they buy in that 3-year or 5-year term, the pre-construction property is being built. They're sitting there and they're waiting for it to be complete.
And correct me if I'm wrong, that pre-construction property, when they're looking at another income property that's like actually built, the pre-construction property doesn't show up on the radar from a lending perspective.
No, it doesn't. Not on the radar from a lending perspective, but from a portfolio design perspective.
Yes,
it's included,
which is very important.
Well,
because we got to close on these things, right? Like on the pre-construction, as well as we want to layer on more properties. And so I love what you said there. Yes, it doesn't show up from the lending perspective and on the radar from a bank or a private lender, but it does. We need to take account for it because we're building out our portfolio here. So
exactly.
Yeah.
And that's one of the reasons why a lot of people run into that wall, right? It's because they buy. It's very easy to get into your first rental, your second rental. The banks are there to support you to get you the financing. But after that, you need somebody to really hold your hand along the way. So in terms of getting that 3-year term and that 5-year, that appreciation, when we know how much money we have access to at that time, now we know, okay, here's the type of property you can buy, the city that you can buy in, and what about the rents are going to be in that time.
Now, I'm going to put you on the spot a little bit, so don't hate me. In terms of somebody sitting down with you right now, looking at an income property, are you swaying and speaking to them about going with like a 2-year rate, fixed,
Great
5
question.
years? Like how are you helping people set up their portfolio with higher rates right now in the environment? But I think from Chris's talk earlier, Chris Slightum and Patrick Fancy, we all kind of believe at some point they're going to come down, not to where they were during COVID in 2021, but what is like, what are you advising to people as you're building out their portfolios as of today?
Well, look, the 3-year rate is the sweet spot.
Okay.
A couple months back, the 3-year rate was the best rate to go on.
Okay.
Bank of Canada has increased interest rates. The bond yield has gone up.
Yep.
3-year pricing has now also increased. It's still the sweet spot in my eyes.
Okay.
Because it'll allow us to give us enough time for the market to correct itself, interest rates to hopefully come down in those 3 years, give enough time for the investor to determine, okay, what are my numbers looking at? What's the cash flow? If it's negative today and it's costing me $500 a month, the way I like to explain it or give it a bigger thought mindset around it is that property going to, if it's $500 a month, that's $6,000 for the year. Is that property going to appreciate more than $6,000 for the year?
I think it's safe to say it will.
9 out of 10 times,
Yeah.
right? The answer is yes.
Yeah. And
right?
I think that's important that you mentioned that, right? Because not everyone tends to, and I understand why, but they look at the fact that the 6,000 is leaving the left pocket, but they're not looking at what's actually going into the right pocket, which is not only the passive appreciation, and I like to go very conservative when we're working our passive appreciation numbers, but also what's being pay down on the mortgage. So overall, you're actually making money. But continue about the 3 years, because I think that is people who are watching right now. There's some people who are actually going through this right now. Like they're actually speaking with you to get mortgages. So I want you to reassure people about the strategy.
Yeah. So 3 year is the sweet spot. A lot of times I'm seeing about 10 to 20% of investors have to go on a 5-year term just because the interest rate is lower, which gets them into that price point that it increases their borrowing power. But that's still okay because it's not for the masses. It's not for the majority of investors. But the ones that get it will still opt into it. The 3-year term is still a very good time frame around what we're anticipating to see what's going to happen in the market moving forward. And I also look at it as from a rate perspective because everyone's rate sensitive.
Yep.
A 3-year rate compared to a 2-year rate is about 40 basis points difference, on an A-lender side. Now, if you're taking a 3-year term, a lot of people say, Chris, I think the rates are going to change within 2 years. And if you do, great. But the 3-year term is really a buffer to give you a different perspective on how are you going to pay off that mortgage within the 3 years, but the penalty around it versus the rate. So if you want to break your mortgage in the second year or you only wanted a 2-year term, it's always nice to take the 3-year because you got the interest rate spread that's lower on the 3-year versus the 2-year. So in the event that you break your mortgage in month 3 of the 3rd year or month 6 in the 3rd year, you can factor in and we can calculate what is your penalty going to look like, which will offset the interest rate on that 2-year term that you were originally going to go on, right? So the 3-year term is always a better niche to move on.
Now I want to shift it to our friends that are self-employed, because getting financing for people who are self-employed has traditionally been tougher than somebody who's on salary. Am I going out on a limb when I say
100%.
So, okay. However, I feel, and again, correct me if I'm wrong, because as a real estate agent, like I have a basic understanding about financing and mortgages, but that's not my expertise. That's your expertise, right? And so I might say something that I want you to correct me because I want to make sure my viewers get the real straight goods, okay? Yeah. And get the right information. Now, I feel like more lenders out there are getting slightly more flexible, if I can use that term, where there is more products in terms of mortgage products that are being offered for people who are self-employed. Is that correct?
Yeah, absolutely.
So far, so good. However, what is the difference in what you need to do as a more independent mortgage broker? And nothing against anybody at the banks, the blue one, the red one, and the green one, and the whatever there is now, the orange one. If you're working with somebody at the green bank, they're not going to tell you about better rates and terms at the blue bank, and because they're not a non-profit organization. The difference with an independent mortgage broker, and I have no vested interest in saying this, guys. However, what an independent mortgage broker can do, someone like Christopher or someone that you might know and have a relationship with, is that they have access to products, mortgage products, probably to the tune of like 450 of them. I know you guys probably stick to about 25 to 30 because those are the ones that you built relationships with. You know kind of when Alex, the investor, is going through a certain transaction, she's probably going to be best fit with this type of lender. You also have access to the products of a bank. But what do you as an independent mortgage broker have to do differently when you're working with someone who's self-employed? And I think within that, as you answer it, will come what a person who's watching right now that is self-employed will have to start to figure out getting these things together if they decide to make and take action on some type of investment.
Yeah. So every bank has their own appetite. Okay, we got A lenders, we got B lenders. A lot of our A clients, good credit, good income, has the down payment, they're all now moving on to the alternative lending side. And the reason being is because they can't qualify in today's market with an A lender, but they do with the B. And that's just a Band-Aid. When I say B, I always say Band-Aid because it's not for a long period, it's for a short period of time. It's usually between 1 and 3 years of a term. But when you do the math around it, the cost of doing business with an alternative lender as an investor is still advantageous to you as long as you have the right executors or team of experts in place i.e. your accountant,
Okay.
that can help you do all of those things. But during COVID, a lot of people, as you mentioned, have got that extra side hustle. A lot of them have their full-time jobs and a part-time job. I'm seeing a lot of people in the tech industry, IT, engineering, anything to do with the consulting fields are now going into the self-employed type business, not working for the man, if you want to call it.
For sure.
And a lot of times what business owners fail to realize is their corporation that when they get employed with that employer, originally the employer's paying them direct. But now you've got your own business. So some people will just go business for self, which I'm a contractor, you pay me, it goes to my personal income. But what happens is when you get a corporation and you're being paid through the corp now is your employer that's paying you your salary. So it's a little easier to get financing from that perspective, because when you're business for self and you're filing taxes, you're paying your tax bracket based on the amount of income that you earn. Versus if you have a corporation and your business is running through it, you can pay yourself whatever you want on the personal side, but we can use your business business deposits that are going into your account.
That's new.
No, it's not really new. I mean, it's kind of changed. Maybe we can use that word.
Okay.
It's changed.
Okay.
Before, we'd have to use 6 months of the bank statements to see the income and expenses that are going in and out of the account.
Got it.
And then we can annualize that income for the year.
Okay.
So instead of paying yourself the $150,000 to go and qualify for that $800,000 property, you can pay yourself a lot less.
Got it.
On the personal side, but then we use the business income to support your purchase and to qualify on the next property.
And really quickly, Chris, because I know what you said probably went over the heads of 76% of the people that are watching right now, but we have you covered. All you have to do is email info@reccanada.com. That's info@reccanada.com, and we'll put you in touch with Chris and to start maybe a conversation, maybe just get a little bit more context about what he's saying for your specific needs and requirements and situation, because we've been at this together now for coming up to 16, 17 years or something like that. That the one thing when it comes to the world of financing, guys, you really got to come to understand that your specific situation is always different than everyone else's. Alex is different than Steven's, and Steven's is different than Laura's. Like, we gotta sit down, and I like to think that I'm the most important person in this whole process when you invest into real estate, but I'm gonna give it up to Christopher because and that hurts me. It's really hard for me to say that I'm not the most important person in the process. It really is the money people. It's why we call him the money man. It's the without the financing, all this stuff is just hearsay. It's great. It's a great thesis. And oh my God, yes, you can create wealth in real estate. But if we can't get the money, then it's really all for naught. And so really quickly, because my team, again, is doing what they do and waving me down. I thought I could go for 5 hours and nobody's going to try to give me the plug, but they are, and the hook. And it is Laura Stewart who's doing it right now. But with that said, in terms of rates, what do you forecast, buddy, in like 42 seconds and less?
Well, look, I think interest rates at some point is going to have to come down. You and I have seen it back in 2005. We saw it in 2014. We bought one of our properties in 2005 where our interest rates are at 5.45% at the time. We've come back to that environment. But for somebody who's self-employed that is now buying properties and has moved from that IT working at Deloitte, for example, and now as a consultant, well, look, as long as they've got 2 years of their experience in the corporate world, in the same field, we can transition them over from the corporate, from the business world into the corporate space and transition those funds into the income, into being able to qualify. So, quickly, there's also an alternative lender space for new business owners that as long as they're in business for 6 months and they have the articles of incorporation, they have their business license, they've got 6 months of their bank statements, we can use that on the insured side, which means less than 20% down, to still be able to qualify to purchase a property.
Love it.
Okay, that's just to get into your first home. But on the investor side, it's always nice when you have the 20% down. Now we start talking about strategizing how to buy under a corporation. Right?
And that just opens up some more.
It just opens up the doors to help you grow your portfolio, and then we determine: are you buying under a corp for this property, or are you buying it under your personal name?
And that's why you need to sit down one-on-one, and you do that by sending a quick email to info@reccanada.com. Christopher,
Thank
I
you, my
really
man. Always
appreciate you,
appreciate
buddy.
you.